Can you go back to Google and Amazon's IPOs and just give founders who maybe were in college when that happened and weren't playing the game, or investors who weren't on the field, what the footprint of those companies were? And, there was a little trepidation, I think, going public at that time as well for both of those companies. Yeah. It wasn't perfect either.
Google was a little bigger because they did this whole planned auction thing. And so I think they were bigger, but Amazon went public, I think, only after a Kleiner investment. I don't think they ever did a B. And they were at like 70 million in revenue or something. They were really small.
Salesforce went public, 60 million of current year revenue, doubling year over year. So it's going from 60 to 120, went public at $1 billion.
Yeah. We took OpenTable public doing $10 million a quarter. So a 40 million run rate. And so it's all possible. Like, it's just a question of whether you're cool with the valuation, and you got to get a bank who doesn't insist that you raise $200 million, because that might not work with the valuation that you're going to have to accept. But I do think we'll see some people move through. It's one of those things. It's going to take a leader, and then you'll have one, and then you'll have two, and then you'll have three.
Stripe's the likely candidate, Bill? You would say Stripe's the one blocking everybody psychologically?
The problem with that is, like, all the big ones, they can go whenever they want. I don't think that really opens things up. I think we need some leaders from non-mega companies to help build the path,
Hey, Bill, one thing that we don't often say, but I think might be true as well. What emerged over the last 10 years was a new class of investors. They call themselves maybe venture investors, but I really think of them as investing in quasi-public companies. These are companies with over, kind of $1 billion valuation. They're late-stage investors. And, they have a self-interest in keeping these companies private for a long time because, like private equity, they can continue to put more and more capital in. It's like a private club for public market companies that only 50 people can compete for. It's a much better market for you to make money in than the actual public market. I don't think it's better for the founders. I don't think it's better for the companies. But,
who's in that club, Brad?
Well, I mean, the names that well, the crossover investors, the Tigers, the Cotus, the Green Oaks, the Altimeters of the world. But then I think there's, all of these.
But what are the companies?
Stripe matches that.
Stripe matches that.
Stripe,
SpaceX,
ByteDance, SpaceX. Go through the list. All of these companies could be public, and I think unless you have a really good reason for the company, to stay private, I think the public markets, as Amazon, as Google, as Salesforce, and so many others have proven, this idea that you can't innovate in the public markets is total nonsense. This idea, it's a cheap source of capital. It keeps, the business efficient and honest. And so my sense is that you're going to see the markets really open up in 24 and 25. We have a backlog because we've had almost no IPOs over the course of the last 2 years. And so, it's just a matter of price. IPO markets are always wide open, Jason. It's just a matter of price.
One interesting thing that facilitates what Brad was talking about is we've become quite comfortable with secondary. And in fact, when we were going through ZERP and there were people with tons of money in their pocket and they wanted to cram it into these companies, they would encourage secondary as a way for them to get ownership because the founders and the early investors didn't want more dilution. So they would literally, knock on doors and say, let us help you do this. And if you're a rather large angel or an early A or B investor or a big founder, it's hard for you to get liquidity through that type of mechanism, but it relieves a ton of pressure on the management team for the employees to be able to get liquidity. And so you find yourself in a forever cycle where these companies might stay private for a very, very long time. And I think we will see a few examples, and I don't know exactly which company, but where that proves to have been a mistake, like for the reasons Brad talked about. And my favorite metaphor here is to imagine a football player that goes from high school to college to pro, and could you imagine, on draft day or a week before draft day, the number one quarterback candidate says, I think I'm going to opt out because, if I play on Sunday, they're gonna be way more scrutiny. They're gonna study all my stats. I don't think I want to play at that level, or I don't want to play in that environment. And everyone would laugh at someone that did that, because, the problem is, once you've started handing out options to your employees, once you take investors onto your cap chart, you're in a game where your job is to constantly increase price per share, and one day to provide liquidity to those people. And so there's no way to opt out of that game. You're in the game, and the better you do, the harder it gets. And so it just keeps going up, but that's the obligation you have.
Hey, Bill, did you guys wait too long to take Uber public? Would you have liked to seen Uber go public before, growth started slowing and, at a valuation less than whatever it was, $50 billion bucks?
And so, we had some pretty big mistakes in leasing and stuff that might have been exposed and dealt with sooner. As Jason has said on this and other podcasts, if you bring up Uber, I have to take a second to just really, really thank Dara for all he's done. Because the first job was to clean things up and put out the fires, which he totally crushed. And then the second job was to increase the value of the company, which is he's starting to deliver on now. And it makes me very happy.
There was no doubt, Bill, in your mind, we're on the topic of Uber, and this sort of speaks to conviction. When you see 1 billion rides going on and the company's losing $1 billion or $2, you never thought this could never not be profitable, because you knew customers would pay a little bit more money. But the press was kind of fixated on this. This can never be profitable. This can never be profitable. This business is a terrible business. But the same people who were saying that were using the product every day. And when the prices went up and the venture, discount and the competition with Lyft started to recede, people had no problem paying an extra $5 a ride, $3 a ride.
My belief, it was all a ZERP thing.
Exactly.
And you had massive amounts of capital. You had a clear winner in a network effect business, but the benefits of that winning were delayed because you had capital being thrown at the second place player in a way that we've never seen before in the history of venture, but we may be witnessing now in the LLM market.
As Bill has described it, which I love, capital was used as a weapon of economic destruction because the cost of capital was free. And the healthiest and best thing that's happening to the venture market is the fact that we have interest rates back at 3.5%, because you can't have number 3, number 4, number 5, number 6 raise capital to compete diseconomically against the market leader. And that allows the backers and the founders and the market leaders to emerge with profitability profiles much, much faster.
Yeah, it was interesting. It was what a wild experience to see that amount of capital used that way. First time in history.
And people looked at Amazon as the playbook for that, Bill, I think. They said, hey, Amazon was never profitable. They broke even, but they built this huge, revenue base. The TAM was huge. Look at all the Prime subscribers. Look at all the adjacent businesses like AWS they were able to build, an advertising business. So there is something to this, I don't want to say lose money at an alarming rate, but a break even and build the business for growth. How do you balance that?
Yeah, I mean, well, yeah. If you know you have a network effect, like how far do you want to push it and how aggressive do you want to be? And Bezos, pushed it. You go back to that moment in time, between 01 and 04, there were multiple times where the press was convinced that Amazon was going bankrupt. And he did have people chasing him, especially in verticals, and he put them all under. Part of it was what we started the podcast talking about, is just the cycle, and he had to adjust his game to the cycle. So in 97, 98, 99, he had unlimited capital being thrown at him. And when that changed, he did cuts. Like, he had to do cuts. He had to get to break even. And eventually he did. So, but look, he's one of, there are, if you look at Bezos, Benioff, and let's say Reed Hastings, they all push the edge of this, like trading off profitability for growth. And I think they all did it in a way they were rewarded for. But it makes for a somewhat frightening ride for the people that are on the yacht.
It's like going up and down the PCH at like 70 miles an hour. You're just right along the edge. You're like, shouldn't there be a guardrail here or something? No, we don't need guardrails. We'll build those later. If your landing page looks terrible, customers are just going to leave. They're going to bounce. It's 2024. There are no excuses for having an ugly website. So stop settling for okay or good enough and have an excellent, a beautiful, an extraordinary website using Squarespace. It's out of the box. Beautiful website designs that will engage your audience, allow you to sell anything, whether it's content or an actual physical product. And you know all these amazing Squarespace features. You've heard me talk about it before, but they have the most amazing, gorgeous templates to get you off to the races instantly. And those templates, they're all designed and optimized for mobile. This is one of the things that makes me crazy. People will design a website on their desktop, but the consumers, 60, 70, 80, 90% of them are experiencing it on their phones. You want to start mobile first. And these templates at Squarespace, they are gorgeous on mobile. Of course, they're gorgeous on desktop as well. And they have an amazing drag and drop web designer. And you get all kinds of analytics now. You don't have to get third-party tools to do analytics. Nope. Squarespace baked that all into their core product. You're going to get marketing analysis, sales data, and more directly inside of Squarespace, where you can create an online store or start a blog or create a subscription business for members-only content and so much more. You do this all simultaneously on the same platform. It's the simplest, most effective, and best-looking way to start a business online. So here's your call to action. Check out squarespace.com/twist for a free trial. And when you're ready to launch, go to squarespace.com/twist for 10% off your first purchase of a website or a domain.